Good afternoon, everybody. Colin just joined us, so we'll give him a minute to get settled in. I'm personally going to stay off video today. We have the flu running through my house and nobody needs to see that.
Come on, Cassie.
I showered today and that's it's about as far as I went. So
sometimes that's all you can do. Or when you say we, that sounds plural.
Yeah, me and my daughter. She got it really rough. Influenza A.
Not good.
Nope. So whenever you're ready, you can take over.
Okay. Let me just save this PowerPoint. Hello, everybody. How's everybody doing? Don't all talk at once.
Doing pretty good, Colin. How about yourself?
Not too bad.
Good to hear.
All right. Let me get my screen shared here and we will get going. All right. Everybody hear me and see my screen?
Yep.
Okay, perfect. Hey, wanted to talk a little bit today about some of these creative solutions that we're hearing out there. There's no doubt that it is a difficult market with interest rates. We're going to get into that in a little bit. So how do we throw the kitchen sink at this? How do we look at what options might be best? And then how do we present those options to prospective buyers? Okay. So as usual on these Wednesday calls, feel free to jump in, interrupt me. If you got questions on slides, please, 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 this is supposed to be as interactive as possible. So do not hesitate to jump in and ask questions and opine as you wish. Let's start with some cold hard facts here. Everybody knows what the state of the interest rate environment is like. If you think about a year ago, a $360,000 home purchase at 2 3/4 would have principal and interest payments about $2,400, right? A $630,000 purchase today at say 7.25% is roughly the same payment, give or take about 120 bucks. So, I mean, that is indicative of how much purchasing power has been sucked out of the market as interest rates have increased. We talked about it several times on Tuesday and Wednesday calls, and I'm sure you're well aware that rates have increased at the fastest pace this year since the 1980s.
Backwards, Colin.
What's up, Jeff?
I was going to say the same thing. This doesn't make sense.
Backwards, just FYI. I think it's supposed to be 630 at 2 3/4 and 360 at 7.25. The percentage.
Yep. Oh, hang on. I could even. You guys get the general point, but yep, you are correct.
No worries. You can keep rolling.
That stuff bugs me. How's that? Perfect.
Oh yeah.
All right. Thank you very much. Thank you very much. We are seeing, a number of articles out here. I know Parker likes to talk about, some of the fear that is out there. I actually thought this was a pretty good piece that was published yesterday. Whenever you see stuff that's a little bit hyperbole, post World War II era, whatever, but this was actually a pretty good detail-oriented case that was talking about Goldman projections, between 5 to 10% from peak to trough, a 7.6% drop in terms of home prices. And then this actually made the argument that, home prices probably will not get to the bottom until March of 2024. Now, and this is a pretty good interactive map in terms of how much overvaluation you might see in particular markets. So, interest rates is one part of the challenge that we have in terms of talking with buyers about the market and, discussing some advantages and disadvantages of transacting right now. But, the other part of it, I think, and I'd be curious what you guys would have to say about this, is that I think right now, the rate conversation is pretty easy. The rate conversation is, look, you can buy the property now. Rates are anticipated to come down in 2023 and beyond. We've seen this giant run up to battle inflation, and there's still forecasts for, 4.5 in some cases, or 5.5, rates that are more reasonable that you can refinance into down the road. To me, that's not that difficult of a conversation. I think the difficult conversation now is what I buy at $360,000 today going to be worth $360,000 or more, because we've had a 10-year bull market and we've had 10 years of housing appreciation in 9 to 15 months. So, I think that's something to keep in mind as you hear some of these creative solutions out there, and you hear people say date the rate, and you hear about 2-1 buy downs. Well, what if we are in a declining market? So I want to get into that a little bit as we jump into this. What is some feedback that you guys have heard in terms of people concerned about lagging prices or falling prices over the next year? And then I'd be curious to kind of hear what your approach is when people say that.
Hey, Colin, I'll go. It's Jen.
Are you calling in from Indiana?
I am currently in Wisconsin at the Quick
Oh,
Trip.
Love
I'm
it.
not driving. I don't know where the hell I am. Somewhere in Wisconsin. Anyway, my concern is like now, we were saying date the rate and yada yada, and everybody was jumping on that, right? And we're doing videos. I did it too, right? And all of a sudden now I'm hearing like, that's horrible advice. You should, not be giving that advice. What if ... And so I'm I'm hesitant to even give much information beyond talk to your lender, because I just don't want any of that kind of stuff coming back to bite me in the butt. What if in 2 years they can't refinance, or the rates aren't better, but now we've given this advice to date the rate, marry the house, right?
Yeah.
Yeah, Jen, I agree with that. I'm kind of these people, it kind of started about a few weeks back when people were like, hey, what's starting to kind of happen? And, I was expecting that these home prices would fall. But like what Colin said, my original thing in my head, I'm a worry wart. And I was like, what if home can't appraise when you go to refinance? And I was like, I don't know what to say to these people because I'm worried about that. And I was reading a crap ton of stuff, and I was like, so I've just kind of, been hesitant to discuss the subject too. And I talk more about different solutions rather than no, I don't do the buy down one. That one scares me.
Yeah, and we'll get into that a little bit. And look, this, nothing's off limits here. The reason why I started with this slide is because I think that way too many lenders out there, and I posted in Slack when you see the actual shrinking of the number of loan officers out there, you've got way too much optimism in the market versus just, let's stick with the facts. Here's where we're at. And then let's play out some different scenarios so that you guys can be as informed as possible when you're talking with people who are interested in transacting, right? I think creative solutions are going to be valuable in this market. And I'm going to talk about pros and cons to both of them. But when you talk about housing prices, Adam, did you want to jump in here at all? Welcome to the team, by the way. Or are you just unmuted?
I wanted to jump in and kind of address what Jen
What's
was
up?
saying.
Yeah, go for it, Cassie.
Totally get what you're saying. I think you need to include a disclaimer to them, right? We obviously, none of us know what's going to happen, but to that point, the sun could explode tomorrow. They could buy a house and they could lose their job. What if? There's always what ifs in every circumstance in life, but also what if you don't make a move now and interest rates stay the same, but house prices continue to increase. What if that?
What if you continue to build zero equity, for example? I mean, I think that's a good point. I want to
I
get
think
into
my point was like more, I know that we can't do that, but what I'm hearing, like when we shared it weeks ago, it was like, yeah, this is great advice to give. And all of a sudden, like the last week or two, I'm reading in different groups and stuff like that's horrible advice to give. So I guess I just don't know enough to know, which one it is. Because it was good a few weeks ago, 2 months ago, but now all of a sudden now it's like, maybe that's not, I don't know which one is right, I guess is my thing. I know that it's forever going to change and I always try to educate the most, right? And it's case by case, person by person. I just don't know when to know when it seemed like 2 months ago it was very well approved to give information to people, and suddenly it seems like people are saying it's horrible information to give. So how do you fix that? I guess beyond the disclaimer.
I think you look at the facts of the program, and then I think you're empowered to make your own decision. I mean, I think that would be the best way to go. So, I mean, let's jump into this and then we can have a real open discussion about some pros and cons of these different programs. But at least I think a lot of people out there are saying, well, 2-1 buy down is a complete panacea that solves all of these issues, or ARMs are a complete panacea that solves all this. Well, what if ARMs adjust up or whatever it might be, right? So let's actually look at the pros and cons here, and then we can determine, how we want to advise buyers as such. We did a 2-1 buy down training about 5 or 6 weeks ago, in which we talked about how the program works. So this is an example of a 2-1 buy down, right? So, I mean, you talk about a loan amount at today's par rate of 7%, $350,000, 30-year fixed. You're going to have a principal and interest payment that's about 32. I'm flipping the numbers all day today. 2328 a month. The way a 2-1 buy down would work is that essentially the seller concessions are going to cover the difference in the monthly payment by buying the rate down 2 points the first year, 1 point the second year, and then the rate adjusts to a fixed rate for the next 28 years of a 30-year term. So if you see this middle column here, this monthly subsidy, of course, why did I click out of that? At $450 a month, the number of payments, essentially the seller is contributing $53.96 as a seller concession that gets held in an escrow account that makes the payments for the buyer. Okay. So this is a seller funded buy down where seller concessions go into an escrow account to pay the difference between 5 and 7% the first year, 7 and 6% the second year, and then you're done for the next 30 years. Obviously, you have a bigger immediate cash flow benefit versus a price reduction, right? If you're going to reduce the price by $8,100, you're probably only going to see, a benefit that is, $30-$35 a month in terms of putting a dent in the buyer's monthly payment. The big benefit to the temporary buy down versus a permanent rate buy down is what I always discuss, which is how long are you going to stay in the house, or more accurately, how long are you going to hold on to the loan, right? Because people love charging points right now, right? They love to charge the buyer a point and a half, 2 points. If you look at some of Quicken's loan estimates, right? A point being 1% of the loan amount, that's, $3,500 that the buyer is paying as a closing cost to the lender for closing the loan. And then if they turn around and refinance in 6, 9, 12, 15 months, that money's never coming back. It's a sunk cost that is points on a loan that you're not going to keep for an extended period of time. The nice thing about the temporary buy down is that if they turn around and refinance in 15 months, whatever's left in this escrow account from this $8,100 that the seller funded is a principal buy down to the actual borrower. right? So it goes to pay down their mortgage by, let's say, $2,100 that is remaining. So there's some flexibility there where that money's not entirely a sunk cost, and it does give them some flexibility to refinance in the form of a principal reduction. Questions on the structure of this, guys, as it's laid out? All right. So let's get into some objections here. I saw this posted and I grabbed a portion of it in terms of, this was an objection to the idea of a 2-1 buy down. You know, if a buyer's being told they can just refinance in the future, well, not if the value isn't there. Prices go down, they won't be able to. Refinances are not free. Most buyers are better off taking a par rate or a permanent buy down or even a credit. Please remember, seller paid closing costs are paid by the buyer, not the seller, in the form of a higher price. And let's see here. And not only do they pay for it with interest of the life of the loan, it's a bigger misnomer in real estate in the declining market. And then, you know, this is interesting to me. Adding to the principal and banking on a refinance in the future is going to bury some buyers. Okay, it's a little aggressive, right? So here's the thing. When, you know, you got to remember there are LTV limitations on seller concessions. So if you've got a 3% down conventional buyer or a 3.5% down FHA buyer, right? You are, you know, 3% down conventional, which I'll get into here in a minute, is really starting to take over a lot of the FHA market. You can only get 3% seller pays on a 3% down conventional loan, right? Well, a lot of people are using up 3% seller pays just to pay the closing costs regularly, right? Mortgage registration tax and title and escrows and things like that, right? So they're not looking at this where, okay, how can we squeeze an extra dollar, you know, $8,000 in this particular example that we just looked at. You know, that's not something that you're going to be able to do on a very high loan to value loan. Very high loan to value loans mean 3% down, 5% down, right? Okay, so temporary buy downs aren't happening on loans that are 3 and 5% down for the most part, right? What does that mean? That means that you would have to see a substantial decrease in property values for the consumer not be able to refinance out of the temporary buy down, right? Let's say you do a temporary buy down with 10% down and you get 5% seller paid closing costs and you use 2 of those percent to fund a temporary buy down, right? Well, the consumer, the buyer has 10% equity in the property for the most part. So it would be a very challenging market if they're not able to refinance 15 months down the road. You would have to see a substantial 7, 8, 9% reduction in property values in order for that to happen, right? So I understand what this point is, but remember that we're not just willy-nilly doing 2-1 or 3-2-1 buy downs on very high loan to value loans. You need to have equity. You need to have a down payment in order to get into the temporary buy down category. Does that make sense?
Yeah, it makes sense, Colin.
Now, I mean, I do think that this is a short-term solution. So, I mean, I think that people get freaked out about 2006, 2007, 2008, and the sort of PTSD that comes from the housing crisis that we saw, in that, you know, well, gosh, why are you qualifying the buyer at, you know, 2 points lower? They're not going to be able to afford the loan once it adjusts up to 7%. That's not true. That's not true. These 2-1 buy downs are always qualifying the buyers at the fully adjusted rate, right? And ARMs for the most part too. You know, so if you look at a 7% rate, that's what the borrower, the total monthly payment of 28 is what the buyer is qualifying on debt to income. So they're not getting this 450 benefit and squeezing through the eye of a needle with a 49% back end debt to income. So there's not reckless lending going on when it comes to this 2-1 buy down. But there are definitely pros. There are some objections as well. It really just depends on the buyer. And you know what? If you have somebody that's a first-time buyer that's maybe only going to stay for a handful of years, it may not be the worst product in the world. Questions about facts on 2-1 buy downs?
I have a question, Colin.
Yeah.
So this temporary 2-1 buy down, we need to get seller concessions, you're saying?
You're correct. Yes.
Well, how much? 2 minimum?
It depends. So I sent the whole team this actual calculator here. So it will depend on what the loan amount is,
Sure.
and then what the par rate is, and then it's really just a calculation. Yeah.
Sure. And then what about your permanent 2-1 buy downs? Do we still need seller concessions at that point too?
What do you mean permanent?
Oh, I thought there was a temporary 2-1 and then the other 2-1
sure.
buy down.
Yeah, so the buy down, you're talking about the difference between just an actual rate buy down where you're paying points to pay down the rate for the entire length of the loan, right? So there's no teaser of the first year, the second year. It's just, but to your point, buying the rate down from 7 to 5 is going to cost a lot more than $8,100, right?
Yeah.
And also along those lines, if you talk about a significant permanent buy down, you better make sure that that house is going to be kept for an extended period of time, because from my perspective, I'll do a break-even analysis. Well, gosh, I want to pay an extra $9,000 to buy the rate down. Okay, that's going to save you $50 a month. That means that it's going to take about 90 payments for you to break even. Will you make 90 payments on this loan? Well, gosh, I don't know. I'm 26 years old. I mean, I'm single. I'm thinking that I'm probably going to start a family, and in 5 years I could be in a totally different headspace. Maybe it's not worth it to put $9,000 of your hard-earned money into a rate buy down right now if you might move in 3 or 4 years, because you'll never actually get the squeeze, the juice from that squeeze. You follow me, Angie?
Yeah. So then my next question is here, let's say we're sitting at 7% and, I just got an email that seller is willing to buy down to 5%. How much are they actually putting up then?
I'm guessing that's in the MLS comments, right?
Well, I got an email about it, so.
And
on
it's not a builder, right?
No, nope.
Okay.
They're like, well, seller's willing to buy down to 5%, so 2% down, from 7 to 5.
I'm guessing, and Cassie, I'd be curious your opinion on this. I mean, we're starting to see more listings that are advertising the 2-1 buy down, but I think that particular listing agent should be careful, because if you take that at face value, that's going to cost their seller a hell of a lot of money to buy the rate down, versus a temporary,
So, I mean, if they're offering that, essentially, what are they putting up? How much? Are you talking like 50,000, or I don't know?
It depends on the price of the home. And then it would depend on the loan amount, et cetera.
Sure.
But
I would agree with you too, Colin, because if they're saying an amount that they'll agree to buy it down to, especially when we don't know the buyer's credit score and what rate they've been quoted and what lender they're going through, I mean, they definitely should have some additional disclaimers.
Yeah, I'll send you the email. It was pretty crazy when I saw it. I was like, oh, that's, yeah.
I'm going to buy that house. I want to jump on that deal. Hey, Jen, what's up? Jen, did you mean to raise your hand?
Yeah, I was trying to hit my unmute. Sorry. So, silly question, perhaps. When it's a temporary buy down, 2-1 buy down, and you're buying down 2% the first year, I'm hearing it cost it saves hundreds, but yet if it's a permanent buy down of 2%, it only saves $50 a month. I don't get that.
Yeah, that was probably a poor explanation from me. My point was, if you look at this $8,100, that would be a seller concession, right? And if you convert that into, you know what, as opposed to us giving you $8,100 in seller pays, we're going to reduce the price by $8,100. That price reduction makes much less of a splash than something like this in terms of the buyer's monthly payment.
That makes sense. Yeah. Okay. Now I get it. Thank you.
Anybody had some success talking with buyers or representing sellers without promising a permanent 5% buy down, a la Angie's listing agent she saw?
I've yet to personally see this in action.
One Permanent Homes team member is now offering that, I believe, with Joe Drest. Talked to him yesterday, so we'll see soon.
I think Mitch has a listing that he's advertising it to.
Yeah, so we'll see. I think Joe just did it today, so we'll see how it turns out.
Nice.
So are they advertising it with the temporary, like the words temporary? Because that's a big difference in price, right? Between temporary and if it's on the MLS, then you have to honor it, right? So like,
No, you don't. The only thing guaranteed in the MLS is buyer agent payout. First and
perfect.
foremost.
Okay.
That's the only
Good to
thing
know.
guaranteed in the MLS. I had Mitchell carefully word it. I can't remember off the top of my head how I had him do it. But I hate to keep using the word disclaimer. I know that we have some disclaimers in there and language with, up to sellers willing to credit up to with the max amount of type wording.
Yeah, makes sense. Okay, thank you. I'm done.
All right. Guys, I wanted to talk a little bit. I posted a video in Slack yesterday about this particular subject. For the better part of the past 5 or 6 years, 680 has become one of, if not the most important numbers in lending. And generally it's because it's a delineator. Middle credit score, 680 and above, almost always went conventional, right? Unless you got 20% down or something like that. I'm talking about, below 20% buyers. So everything below 680 generally went FHA. And that's because all lenders had something called loan level price adjustments that were handed down from Fannie Mae and Freddie Mac, where they said, look, if you don't have a 680 credit score or better, go FHA. And, they didn't say that because the product was still available, right? But the price adjustments made it so painful for 3% or 5% down conventional buyers to look at going conventional. The PMI was through the roof, the rate was through the roof, and they're like, you know what, forget it. I'm just going to go FHA. But over the course of the last couple of weeks, the GSEs, the government-sponsored entities, Fannie Mae and Freddie Mac, have said, oh man, we need some loans. And maybe we should start looking at making these 3%, especially down payment conventional loans, more accessible to the public. And so they've done a couple of different things. Number one, as of today, they've adjusted their qualifying range for 3% down conventional buyers. It used to be that, 4 months ago, you had to make about $83,000 or less in qualifying income in order for you to get a 3% down conventional loan that was affordable, right? Then they raised that median income up to about $94,000 and change. That was about 2 months ago. And now it's $117,000. That is the 100% of the area median income. And you guys actually have access to this. This is a publicly accessible property and income tool where if you just plug in 55124, wherever you want to look, it will pull up. You put listing addresses in here. You can put buyers addresses in here, and usually it works, but why would it work when we're in the middle of presentation? What it will do is that it will spit you out what the area median income is. Come on, you got to be kidding me. All right, for real. Well, my apologies. I don't know why that's not working right now, but what my point is that 100% of the area median income is $117,800. So if you have qualifying income, so you can exclude bonuses, you can exclude one borrower's income, you can do a lot of different things to put this puzzle together to make income that is less than $117,800, then you're now in a 3% down conventional category. You also qualify for a $1,250 credit toward down payment or closing costs, which has been a very popular product with all of us, myself and Matt and John at Flex, in terms of, hey, this is a very good benefit. If you're going 3% down, you might as well get an extra $1,250 out of it, okay? But the bigger deal is that these price adjustments have been lifted on 3% down conventional loans. So now you have a 660 or a 655 or a 645 credit score, you can do a conventional loan. All right. And it's not going to cost you an arm and a leg. Matter of fact, the rate's going to be almost exactly the same as somebody, whether you have a, 640, a 740, or an 840. And that used to be the big benefit to FHA loans, is that the rate was always the same regardless of the credit score for the most part. Right. Well, now conventional in this category has adopted that sort of thinking, which means that, if you're below 680, you now have access to conventional products. And that's going to help a lot with houses like this, as you see on the screen. Well, it actually may not help with a house like this because there are minimum property requirements. But if you think about it, FHA has been such a challenged product with properties that are in a certain price point because they may not meet minimum appraisal or minimum property requirements, right? So with this opening up the door to conventional, I think you're going to see a lot more properties that are 255. Even, Alexa, you and I were talking about buyers down in Owatonna, I think a couple of days ago, right? It's like, gosh, they're at 160, 170, and you're seeing, a lot of alarming things when you tour the property in terms of the condition that it's in, that by no means are going to pass FHA. But now you've got buyers that have conventional accessible to them, even with marginal or fair credit scores. So this is a big deal. I think it's going to bring a lot of previously labeled FHA buyers back into the marketplace. And I also think I've always been a bigger fan of conventional loans than FHA loans. It's 0.5% less down. The PMI is not life of loan. It eventually goes away. And there's no upfront mortgage insurance premium that gets rolled into the loan. I mean, you realize whenever you do an FHA loan at 3.5% down, the government takes half of that immediately. Right? You just don't see it. It gets rolled into the loan, 1.75% mortgage insurance premium up front. So this is certainly something that is going to be valuable as we go into 2023 and beyond. Questions about 3% down conventional, these loan limit price adjustments, the area median income, et cetera? There we go. Came up. So you'll see, you can plug the address in here. It'll give you the county. It'll give you the, this 100% median income is what's being used now. And this is for the entire United States. So you can plug any address into this. Okay. Got to get back to where I was. We talked about buy downs, lock and shop. I'll just add this. It'll be the last slide here, guys. This is something that we have used that has been beneficial for buyers that might be 60 to 90 days out. Maybe they're on the cusp of not qualifying. You know, if rates go up another 0.5 percentage point, they're not going to be able to secure financing on a property. Lock and shop is good, where previously, and some lenders are still in this category, you got to have a purchase agreement. I can't do anything until you have a purchase agreement, right? Well, now you can lock a buyer in for 60 to 90 days and plug in the purchase agreement address when that comes in, right? So that has been valuable. There's no cost up to 90 days. And then, you know, if you've got extended lock period of times, that those are still available as well, up to, I believe, 240 days. So something to keep in mind, that you can be a little bit strategic about when your buyer locks on the broker side. Questions about anything or anything you guys want to discuss?
What do you have anything for? So just a little bit of a creative question. I'm going to start calling them. So say that Mr. Buy Down Refinance, the dude that wants to do, you know, the little ones for the 2 years and then it's locked in for 30. Could he sell his home on that 3rd year to someone who has some type of loan option that doesn't care about an appraisal coming out correctly? Like, is there any loan option for a low appraisal?
Talk me through it a little bit more.
Okay, so I'm trying to remedy, say that prices do fall that extra 9%, and someone decides, you know, I'm going to start a family in 3 years, so I don't even want to stay in this. And instead, I would rather sell this one off to somebody else and then not refinance because you're getting a different home, but then get that new interest rate that is lower. And I wonder how they could get it off of their hands, the property, if it doesn't appraise.
Well, if you're going to do a 2-1 buy down, you pretty much need to have 10% down, right? Because if you look at our seller charts, you know, what we talked about earlier. So, and I'm just going to look at this. So what I would say, Alexa, is number one, there's the assumability if it's a government loan, which we covered, I think, 2 weeks ago, right? So, you know, if it's an FHA loan, VA loan, USDA loan, that is potentially assumable, right?
Right.
And assumable, you know, when you do assumptions, there are no appraisals, right? So, I mean, that would be number one thought that I would have. You know, Caitlin Schmiel put this together for us as a co-branded. So, I mean, if you think about a conventional loan with less than 10% down, you're only going to get 3%. So, I mean, I think that, you know, what does that mean? Kind of to hammer this point home, if you're going to do a temporary buy down, you're pretty much going to be 10% down plus, which should protect that buyer turned seller from being underwater.
Okay. Okay. Yeah, I gotta go watch those videos. I'm doing a mortgage day today.
Anybody else questions? All right, right on. Well, thank you all for being here. Jen, your hand is still up, but I don't know if that's a holdover or not. All right, guys. Cassie, thank you for putting this together as always every Wednesday. If you guys have more questions about this, feel free to hit us up, myself or Matt or John. We're here to help.
Thank you, everybody. Have a good day.
Thank you.